Welcome to Kaiser Watch with John Kaiser. I'm your host, Jim Goddard. Welcome back to the show, John.
Jim, pleasure to be back on the show.
John, what was the PDAC conference in Toronto like this year?
I talked to one person today who was on his way to the airport, and he described it as a zoo. And I was there for 1.5 days, Monday to Tuesday, and I can agree it was, in both a positive and a negative way. I'll start with the negative way. This conference, unlike the traditional one that's held in March, which starts on Sunday and finishes noon on Wednesday, this one started on Monday and finishes 5 o'clock on Wednesday. And the people who've managed to show up on Sunday, they could go and pick up their passes at the South Convention Center, have their badges ready, and be able to go on Monday morning. Other people like myself who didn't really have that opportunity, we registered online and we got our little QR code emailed to us on Friday, and we were supposed to go there, walk up to a kiosk, show it, and get our badges printed out, and there's a human being handling that process. So it takes 2 to 4 minutes depending how well things work. So I figured, well, the show opens at 10 o'clock. I have an interview at 10:30. I have my Pieces of 8 roundtable at 11:30. That's part of the PDAC conference. I'll show up around 10, get my QR code scanned, and walk in there with my badge. I get there at 10 o'clock, and there's like 500 people standing outside the doors. I mean, what's going on? Oh, they're not letting anybody in. At around 10:30, they started letting in people who had an exhibitor badge. And by around 11 o'clock, they were starting to let in people with all access badges. And at that time, they said, anybody who doesn't have a badge at all, you need to come back in 1.5 hours because we are still clogged. I said, what the hell was going on? By then, there were 1,000+ people standing around trying to get into this show. Even exhibitors who still had to pick up their badges were stuck outside. This was a gong show. So what went wrong? Well, it seems that the people who, like myself, who needed to scan their QR code, they showed up relatively early and got into the facility. Now, the South Convention Center in Toronto, it has 4 levels. There's the entrance level. You get in, you instantly go down an escalator. Then you get to some sort of a small footprint mezzanine level, which is where they usually set up the registration kiosks. And from there, you go down another set of escalators to the 700 level. And there at that escalator is where the security guards are checking your badges, making sure you're fully registered. And then you go down to the 800 level, the dungeon where the trade show and the investors exchange is located. So all these people who wanted to be in there right away when it opened up, but still had to get their QR codes, they showed up early, got in there. But when you think there's only about, say, 50 kiosks, and it takes about 3 to 5 minutes, you're going to only be able to process 1,000 people in an hour. So this created an instant bottleneck. And the problem was that this blocked the corridor to get to the escalator that goes down to level 700 and eventually onward to 800. So all the people who had picked up their badges, they showed up sort of just in time. We're going to just walk in. We're already taken care of. And they run into this wall of people. And then the health and safety people freaked out and said, oh my gosh, this is a fire hazard. And they literally chased people back outside and blocked the door, and they blocked the north entrance also where people were streaming in. And they had to wait for this bottleneck to resolve itself. And it would not have been so bad if they had created a separate corridor where people with badges would simply bypass all the rest of us who are either still getting registered in person or we're trying to get our QR codes scanned. So this was like terrible because they were charging, $25 a day for a simple exhibit pass. I had one of my subscribers come in that day all the way from the outskirts of Toronto. he didn't get in there until 12:30, 1 o'clock. Now, this was I think they did not quite understand the dynamics for opening it on a Monday like that with such a large crowd of people compared to before. People got their tickets on a Saturday. They showed up on the weekend, and Sunday was not such a important day, so it was more stretched out over time. Now, that was sort of the negative zoo aspect of it. The positive zoo aspect of it is, I managed to bypass the problem because I got in touch with people inside for whose interviews and show I was supposed to be present, and they were able to bring me somebody else's access badge, which I then wore, and I was let in. And eventually, I got my own day pass exhibit pass around 1:30. So I went to the Pieces of 8 roundtable, which Peter Bowdish organized. Peter Bowdish has for 20 years run the newsletter presentation session that would run all day Sunday. This was his last one. He's basically retired now. So he had 8 of us there answering questions. It was a really good session, lasted an hour and a half. But this was in room 801, and it was only a quarter full. So I was thinking, okay, this was some sort of strange bottleneck that I saw in the beginning, and here's the reality. This is going to be a morgue down on the exhibit floor, like Cambridge was in mid-May, where it was basically just exhibitors talking to each other. And then when this is finished and I get into the investors exchange floor, I'm like, what the hell is going on here? The place is packed. I haven't, and in the last 5 years, or between 2015 and 2020, I don't recall ever having to very carefully navigate my way down the aisles, past and around people to get to where I was going. There were lots and lots of people there, and they were also smiling. Like I'm thinking, okay, the market tanked Friday, the market was tanking on Monday when I was there. Eventually tanked on Tuesday some more. On Tuesday, they were also still smiling. Why are all these people smiling? Why are all these people here? And I started to look at the badges, and they've got them color coded. The exhibitors have an orange badge, so you have about 350 companies exhibiting there. You assume they have about 3 or 4 people. So maybe 2,000 people are running around with these exhibitor badges. Then I'm noticing all these all-access badges, and the all-access badges cost $500 to $800 to be there for those 3 days, and that gives you access to the trade show and the technical the investors exchange and all the technical programs and whatever events they've got scattered all over the place. But that's pretty expensive to pay. And the reality is that the retail people, they pay $25 a day to go in, and they get the trade show and the investors exchange. So the question I was asking is, okay, how can these people all afford it? And then it sort of dawned on me, these all-access people, they are industry people who work for some sort of company that's involved in the resource sector. And that's why they're here with an all-access pass, because they're not paying for it out of their own pocket. So this swarm of people with the people with the green badges, the sort of retail investors and the odd high net worth or broker that dropped by just to check things out. That group was in very, very, very small quantity. It was the industry that was present at this show. And why were they smiling? Even though it looks like, we're going to head into a recession with interest rates cranking up to control, subdue inflation. Why are they so happy? And the reason is the industry knows that the resource sector is on the threshold of a major boom. They know that the part of the problem of driving inflation, is too much money chasing too few goods after the pandemic finally ended. But a bigger reason is that the prices of material goods are going up. There's also this business of reshoring manufacturing capacity from places like China. That's also going to increase prices. So you've got a certain amount of inflation that's going to stick around, and that means they're going to keep jamming up the interest rates to try and make it go away, but it can't go away unless a lot of money goes into the resource sector. And this is even on the macro scale. If you assume globalization is going to be around, come back and not disappear as everybody's saying, there's a shortage of supply in the pipeline based on projected macroeconomic growth and the emergence of new technologies related to the energy transition. So everybody knows that, even though our stocks are getting whacked right now as collateral damage in the general pullback, of the general market, there are good times ahead. So everybody's out there renewing the contacts, checking out who they need to do deals with, who they want to sell their services with, and only a relatively small percentage of this delegate population could be counted as investors who are actually looking to take advantage of this situation. So in a sense, the zoo-ness of the PDAC conference was, for me, a very bullish signal that I'm not just drinking my own Kool-Aid in thinking that we are about to witness a bull cycle for the resource sector, even if we see the economy kind of flatline for a while and the general equity markets flatline for who knows how long after the interest rates finally stop rising.
The recent market sell-off was triggered by last week's inflation report, which showed the consumer price index rose from 8.3 to 8.6 in the U.S. rather than dropping. We've now seen a 0.75% rate hike by the Federal Reserve. How high will rates need to go before inflation declines?
We have no idea how high they have to go for, inflation to subside. Now, back in 1980 to 82, inflation had hit 14%, and Paul Volcker, the Reserve Chairman at the time, he was dealing with a feedback loop caused in part by the cost of living adjustment clause, the COLA clause, where you would have wages and salaries go up in response to prices, and then prices would go up in response to the higher labor input costs, and you had this spiral of prices rising and rising, and part of it was due to the money supply expansion, but you also had in the background the oil shock, oil going from $2 a barrel to $40 a barrel as a result of the OPEC supply squeeze, and that created a physical inflation, which no kind of a monetary price shock could do anything about. But there was also asset inflation. Real estate had done really well, and Volcker cranked interest rates to over 20%, and at that level, you can't finance anything because so much of the payment just goes to interest. Most people cannot afford that. So that caused everything to crash. It caused a recession to emerge. Unemployment went up, and this inflation spiral was purged from the system. Oil came down to $20, where it kind of hung around for most of the 80s. And the economy, when the interest rates started to drop, that created a bull market in bonds. The economy revived, and the 80s were a very good period. So today, the situation's somewhat different. We had a decade of monetary expansion through quantitative easing to deal with the 2008 crisis, and despite all the inflation predictions, it stayed below 2%. But what we did see was massive inflation of asset values in real estate and in equity prices, and of course because bond yields went down to zero and actually negative in Europe, we saw a massive gain in the principal value of the bond market. So there was this huge expansion of asset value, and that created a very positive wealth effect, and that's to some degree responsible for stimulating the demand once the COVID pandemic started to wind down last year and people started to spend money on things, you started to see the demand exceed the existing supply, which itself had been compromised by all the responses to COVID mitigation, and exacerbated by China's zero COVID policy, which has really hamstrung the ability of China to continue to be this manufacturing center in the world. And so, COVID had been the first shock that arrived in this particular cycle. And it actually helped to expand the money supply. Interest rates went down very low again. And then the second shock occurred this year when Russia invaded the Ukraine and forged an alliance with China, basically the autocracy alliance, to square off against the United States and its democratic allies. And that took some additional supply offline. So now we have this situation where we have already embedded raw material supply deficits. We've got a lot of physical goods now not arriving. That's causing scarcities that cause the price to go up. That's very visible. Taking Russian oil and gas offline now increases the price of fossil fuel energy. So that makes everybody unhappy. That contributes to the inflation. But the inflation's really across the board because the ability of capital to respond to demand, it is compromised for a while. So Jerome Powell's job is to somehow cool this economy without crashing it. And what's interesting about this particular tightening cycle is the market understands that the party is over. We've had interest rates super low, which means the principal value of bonds are super high. We've seen pricing in the equity markets based on very, very low competing yields in the bond market. So the multiples that you get for growth projections have been very high. And that punch bowl is being taken away. So to a large degree, it is the threat of higher interest rates which is now deflating the asset values that are contributing to the net wealth effect of people out there, which of course contributes to demand exceeding the ability to supply and therefore creating inflation. So we saw all this when the inflation numbers came out, 8.6%, 0.5 points higher than 8.3%. That takes us back to that 1980 period, that early 80s when Volcker was trying to control it, and the market realized, oh boy, here it comes. So they actually priced into the market this 3/4 point rise, and there will probably be more. When it came out, the market actually stabilized and went up slightly. People said, okay, let's see what happens. I suspect there are more hikes coming. There is more air to be taken out of the general equity markets because Powell knows that he at some point will need to lower interest rates in order to revive the economy. It's pretty unlikely that the Democrats will hold the House and Senate in the midterms. That means when you have Republicans controlling the House and Senate, they will do their best to harm the American economy by blocking anything that smells of fiscal stimulus that could turn things around. So it's going to be up to monetary policy in case these interest rate hikes overshoot the intended effect of cooling inflation and topple the economy into a significant recession. But an important idea that's going to emerge from all this is that we have to go through a period of higher prices in order to adapt to this new reality that the world is partitioning back into autocracy versus democracy. It's like the Cold War being revived, and globalization, which has been the engine for figuring out where stuff is made and where you get it from. That whole model is falling apart. We're going to see the world fragment into separate zones. And with Russia and China controlling much of the raw material supply for the rest of the world and the United States domestically producing a tiny fraction of the total, and certainly not what you would expect for the economy that is the biggest in the world. There's a crisis brewing which requires new mines to be developed, new refining, smelting, processing facilities to be developed in secure jurisdictions outside the Russia-China axis, and also moving manufacturing back from China into the United States. I mean, you could use the foundries that make semiconductors in Taiwan. That's a huge vulnerability. It takes several years to build new ones, and they cost billions of dollars. That all has to be moved into places like the United States, and widget stuff, physical good stuff manufacturing. When you do that back in the United States or Canada or Europe, you have much higher ESG standards to comply with. So there is going to be an inflationary adjustment to a new reality, the alternative to which is that you have super inflation in the sense that, well, there's just nothing available except a handful of products because it's not coming from the traditional centers. So Powell has to navigate this different arena and somehow, not try to subdue inflation back below 2%, somehow get the market to understand that some inflation is going to be here, but it is going to be of a temporary transitional nature. And this is, of course, going to be good for the resource juniors. Other things, profitability is not going to grow as companies rebuild their production capacities with a higher OPEX and CAPEX, and they will, of course, have to charge more for their goods. But for the resource sector, this is a window where suddenly there's going to be capital in there to make sure that this is happening. And an example interesting this week is that Linus has basically been given $120 million by the Pentagon to build a heavy rare earth separation facility in Texas so that this capacity exists in the United States. The scale of this sounds like it's way more than Linus can provide from its own operations. That's the Mount Well's mainly a light rare earth operation, but this capacity to separate these heavy rare earths, it actually needs to exist before the reality of the mine concentrates, the cracked heavy rare earth mixed oxides are made available. So we're finally seeing sort of the government understand that it's stepping in, it's going beyond just talking about this, it's putting up this money, and Linus will be facilitating, like it brings the technical know-how to get this set up. And this is again a sign of why there's going to be a bull market for resource juniors that are able to come up with these critical metal projects and push them into the development pipeline, and the farther downstream processing that in the past 20 years has all shifted to China, which is an extraordinary vulnerability in this new Cold War. The governments are now stepping in to make sure that it doesn't simply not happen because it isn't available to take the mine output and convert it into the form finally needed by the end user. So more interest rates hike coming, nothing like in the early 80s where it's going to go to 20%, but we're going to see repeated rounds of this as the market anticipates, okay, more inflation, another 3/4 point rise. So there's going to be this ratcheting effect, and at some point the resource juniors are going to just say, well, this doesn't really affect us, and yes, it deflates the net asset value of everybody. Their wealth effect goes down, but we're such a tiny relative sector that we can flourish against this backdrop of an emerging recession and deflating real estate, bond, and general equity prices. So I think that's another reason that people at the conference, even though our resource juniors were being whacked, they didn't care because they know we're just temporary collateral damage. We will bounce back a lot faster than some of this other stuff. And boy, if I were owning crypto, I would be selling it as fast as I could because I do not see how this crypto Bitcoin could come back in an environment where we have the liquidity reduced in the system, and where this trend is, my friend, speculation mentality is completely gone. There's no use for Bitcoin whatsoever. This can go back to $5,000 a Bitcoin in a heartbeat. And when that happens, then you're going to see an audience that, obviously we can't gamble on Bitcoin. Maybe we should look at this resource sector for which the physical need remains intact and in fact is growing, not just because, the energy transition, but also because we're changing where we get everything from, thanks to this emerging battle between autocracy and democracy.
Goldman Sachs published a Battery Metals Watch report in late May, which declared the end of the beginning for the battery metals boom. The report says lithium will end up oversupplied between now and 2025. What does that mean for your prediction of Lithium Mania 2.0?
Well, this report by Goldman Sachs created quite a stir, because in essence they seem to be pulling the plug on the whole battery metals boom that's going on. And Benchmark Intelligence, which is a sort of a research outfit that tracks all these critical minerals and how they relate to the energy transition, in particular lithium, they normally don't bother responding to these reports from other parties, but they felt the need to do so and actually published a 5-point rebuttal to this idea that it's pretty much over. And I finally got hold of the Goldman Sachs report and read it, and it's not actually that negative. What they're saying is that between now and 2025, we will see the imbalance between lithium demand and supply resolve itself and actually go into oversupply, which should bring down the price of lithium carbonate and lithium hydroxide, the battery grade input materials. And they did not say where they think the lithium prices are going to. They're only saying that they are going to go down. Well, I've been saying they absolutely have to go down. The sooner they start going down, the better it is for Lithium Mania 2.0 and the ability of the mining sector to mobilize new supply. Goldman Sachs is in fact even more bullish than Rio Tinto about long-term lithium demand. They're predicting a 10-fold increase in battery demand by 2030. Rio Tinto's numbers suggest this 10-fold increase won't really be in place until about 2035. And lithium demand in 2021 was about 100,000 tons of lithium metal. And that's up substantially from what it was 5 years ago when all this began. What Goldman Sachs is doing is it's looking at what happened during Lithium Mania 1.0 and saying it's about to happen again. In 2015, when all these companies got into the lithium brines and the Australian juniors woke up and started a map delineating all these pegmatites in Western Australia and actually getting them into production, the result was an oversupply of lithium in its various forms, which crashed the price from a $10 to $15 per pound lithium carbonate level all the way down to $2.50 a pound by 2019. And that helped contribute to the Nemaska's bankruptcy, the Whabouchi project that was being developed in the James Bay area of Quebec. And that created a very negative attitude, and that sort of $2.50 to $3 a pound. None of these pegmatite deposits work. Maybe these lithium brines will continue to work. SQM has produced lithium carbonate from its brine operations in Chile for decades, and the price has been sort of a flatlining $2 to $3 per pound level for many decades. And it was only with the emergence of the lithium-ion cell application that a whole new reality emerged for lithium, because the past usages were limited to glassware and ceramics, and then later came the laptop and cell phone demand. But this EV demand, it's like if you're going to replace the ICE fleet by 2035 with electric vehicles, you're going to need 1 million tons of metal supply emerging between now and then. So, but now we're seeing with the lithium carbonate rocketing to $36 a pound during the past year, it has it's kind of ridiculous at that level. And Goldman Sachs is correctly saying this level is not sustainable. And I look at this future demand and I do the calculations. And gosh, what would 1 million tons of lithium metal be worth at this, say, $40 a pound? And that turns it into a $400 billion a year market. To put that into perspective, copper last year was worth $200 billion. Aluminum was worth just over $100 billion. Nickel was worth around $50 billion. So that would make lithium one of the most valuable, important metals in the world. In fact, it would make it equivalent to iron, which was worth about $400 billion last year. So this can't really happen. And at that price, the EV exponential adoption won't happen either, because the EVs won't be affordable for the masses to adopt. So it's got to come down. But Goldman Sachs is sort of suggesting, well, the optics of it coming down is going to be very negative for the the whole lithium battery materials sector. Now, with regard to cobalt and nickel, which are part of the cathode, there's all kinds of configuration changes coming. For now, there's the lithium iron phosphate deposit, which doesn't have any nickel or cobalt in it. We don't know what that configuration will be, but we do know that lithium will be part of this first generation of electric vehicles that replaces the internal combustion engine cars. And this is without a technology breakthrough that creates a solid-state electrolyte that allows lithium metal to be substituted for graphite in the anode, which makes the perfect type of battery to overcome all the objections people have to having an electric vehicle. So I think seeing the lithium carbonate price come down to $10-15 is a good price, because at $10, any lithium pegmatite, lithium-enriched pegmatite that's grading 1% or more of lithium oxide, it's probably in the money. And we, of course, need the size and location and the purity level of the concentrate also to worry about. But the big part of this tenfold expansion, the Australian pegmatite, the additional pegmatite supply that can come, the additional brine-linked supply that can come from the lithium triangle, it can't deliver all of that. And Goldman Sachs' argument about an oversupply, they're actually talking about a difference of 33% supply versus 27% demand by 2025. Well, that's so close that it doesn't mean anything at all. And it's all premised on the views of two of their analysts who work in the China Materials Division, who are looking at the Chinese attempt to exploit their lepidolite-based pegmatites, which is different from the spodumene-type pegmatites that Australia produces. And these are of a lower grade, that they're dirtier to process, have higher input costs. And Goldman Sachs is saying that, well, China is going to ramp up supply of this, and that's going to reverse this imbalance and tank the price. Except what's happening already is that the long-term prices for lithium carbonate and lithium hydroxide, they aren't at the spot price where it is now. The spot price is one of those exponential explosions. It looks somewhat like what the rare earth prices were like in that 2009-2011 period when they went way up. I mean, at the current $35 price, these pegmatites running 1% or so, they're like $1,000 to $2,000 rock value, and these are open pitable deposits. But the whole rare earth thing was one of suddenly withholding existing supply and basically doing a squeeze on the end users. this is different. Here we're dealing with emerging demand that's unfolding over time, and there's this sort of a lag and then overshoot in supply to deal with this. And I think it may not be long before Goldman Sachs puts out an updated note suggesting that even if carbonate prices go down to 10-15, well, that's where the long-term prices are starting to stabilize. That's where the new supply that's needed to make this EV fantasy a reality can come into existence. And where's it going to come from? Well, at least those 500,000 tons of that million tons a year required by 2030 to 35, it's going to come from the pegmatites in eastern Canada. And that's what Lithium Mania 2.0 is. These are spodumene-based pegmatites. They are not as visible as they are in Western Australia. They're under moss and gravel and swamp and bush, and they are known to exist, but they've always been worthless. So Lithium Mania 2.0, even if Goldman Sachs is right that there'll be an oversupply and a bit of a negative call with the producers because they're not getting $30 a pound, which they aren't anyways, this supply that the Canadians are going to deliver, it won't arrive until 2028 if they start delineating and developing it and permitting it now. So the Lithium Mania 2.0, this can emerge right now, even while Goldman Sachs seems to be talking the market down at the same time as it's saying this lithium is going to be a huge market. And again, at $10 a pound, that future million tons of lithium metal annually, that's worth $100 billion. At 20, it's $200 billion. This is an extraordinarily serious market that's evolving, and the whole Canadian scene, Eastern Canada, which is ideal for this and could have its own green bushes hidden there with only a little patch of it exposed, and nobody ever bothered to look further because, you know, who needs a small 2% lithium enriched pegmatite in Canada when we have Tanco and the brines in Chile and the other pegmatites from Australia. So no, the Goldman Sachs' report is not as negative as it has been made, but it's creating tremendous publicity by generating this bull versus bear attitude, and it's causing people to discuss and say, okay, why is this report out? Why are they right or wrong? So it's actually educating everybody about why there is this need to go on a great lithium pegmatite hunt in eastern Canada so that this supply is available, starts emerging in this 2025 to 2030 period, about which Goldman Sachs is actually quite bullish. And when you're just an explorer developer, that's not the same thing as it is with a producer who, you know, if suddenly there's an interim slump, you make less cash flow. And this is different from gold because what the current price is always dictates what people expect it's going to be tomorrow. That's why when gold starts trending down, everybody is unhappy about the juniors and so on. Here we're talking about something the world actually needs, a lot more lithium, and the juniors can ignore whatever interim fluctuations, and I'm arguing that a downtrend in lithium carbonate is actually good for the long-term idea that EVs will replace the internal combustion engines by 2035 and at least to some degree reduce global warming. And that's why I think the younger generations are going to discover this sector. It's going to become the gateway to learn about how does resource exploration and development work. When they bet on a resource junior looking for pegmatites in eastern Canada, they are contributing to helping save the future for themselves, for their children, and perhaps even their grandchildren. So they care about it in a way that older boomers such as myself don't personally care, though I do care for my children and grandchildren.
John, thank you so much for the update.
You're welcome, Jim.
We've been speaking with John Kaiser. I'm Jim Goddard. Comments made on Kaiser Watch are an expression of opinion only and should not be construed in any manner whatsoever as a recommendation to buy or sell any financial instrument at any time. Archived online at kaiserresearch.com.